Just in case you were planning to check out for the rest of the month of December and enjoy the holidays, don't. Because the markets are facing an absolute perfect storm of event risk this week to bookend what was already a very action-packed year back and forth. And this week, it is an absolute wrecking ball of macro event risk, one after the other, that is going to batter investors. So we'll take a look here at the big and important points on the calendar. This is Ilya Spivak, head of global macro here at tastylive, and this is, of course, Macro Money. Welcome. We are going to start with a look at where the markets were last week, what they did, whether there's anything to glean there, and then take a look at the big inflection points this week. There are so many of them that we're only going to get to the absolute most potent ones. But even just there is all kinds of things to chew on. So without any delay, let's jump right in. Here's what the markets looked like last week. And we can see here a relatively staid week for the most part. Stocks a little bit higher, but again, very muted performance. S&P up just 0.15%. So quieter than the prior week, even where it was very modest already. NASDAQ a little bit more chipper. It was flat the prior week. It added about 0.5%, but all in all, very quiet week on Wall Street. Looks like a corrective week for yields. They had massive declines in the prior week. The 10-year was down 6. The 2-year was down more than 8. So marginal recoveries there last week. Definitely looking corrective, just modest retracements with markets seemingly digesting the prior week's losses. Crude oil down for a 7th consecutive week. Not a whole lot different there. Still disappointment around slowing growth, around OPEC looking like they are not in a position to really convince the markets that they're going to be impactful with their output caps. And of course, they haven't really been impactful with their output caps in earnest pretty much ever. Since these caps were introduced in 2014, not one time really has OPEC actually delivered on those caps. It's overproduced relative to them consistently. So not surprising that the market ultimately wasn't convinced. Gold correcting a bit after gains the prior week. Not a whole lot going on there. Again, things seemingly oscillating, down 3.5% last week, up 3 1/3 the prior week. Obviously, that leaves gold a little bit net lower, but not a whole lot. And the dollar, really the sole standout here, managing a little bit more gain and a little bit more broad of a gain. Here we're looking at the euro as a kind of liquid counterpart to the dollar, the most liquid counterpart to the dollar, as being down about 0.6%. The prior week, that was more linked to the euro's own weakness, but then down 1% last week. Both of them reflecting continued dollar strength or dollar recovery. Obviously, November was a very tough month for the dollar. And now the strength a little bit more broad, though it's mounting against the euro, but it's building in other places now as well. So a generally quiet week, mostly consolidative for markets. The dollar, the only one with a move that was really any kind of standout, but of course that itself is a correction in the context of a much larger sell-off in November. So it doesn't look like the markets really did much of anything or had any kind of a really significant trend move. Gold, of course, was very spiky, but ultimately those spikes didn't really deliver on any sort of trend development in a meaningful way. So with all of that in mind, we now face a week where things might get much more active. And the level of volatility might be much more elevated because we now face much more significant, much heavier duty event risk. And we begin with US CPI data. And this is, on any normal week, a critical bit of event risk. This week, it is probably the least important of the big headline announcements. The expectation is that the headline number will continue to inch lower, down to 3.1% from 3.2. That would be the lowest reading since March 2021. So disinflation certainly continuing with gusto here, but much of the shift expected to come from continued decline in energy. We've just said crude oil has been falling for 7 consecutive weeks at this point, and it looks like that's probably a big part of that story. Natural gas, of course, is basically in free fall at this stage, so still moving lower and still giving us that negative influence from energy on overall inflation. We can see that's those yellow bars on the bottom of the chart below zero. They've probably gotten a little bit deeper again in this latest November CPI reading. So we are likely going to attribute much of what happens at the headline to what's going on there. Food inflation has also cooled a bit, so that might be a further influence. The key for the Fed and for markets thereby, though, is the core figure. And here we're not expecting changes. Now, we should note that this was the story the prior month as well. Markets were looking for the core reading to stay flat at 4.1. It came out just a touch lower at 4, and the markets went ballistic. They immediately moved to pricing in a much more dovish Fed policy outlook, with, of course, implications for stocks, for the dollar. Stocks rose, the dollar fell, yields fell, bonds, of course, rose. Bond yields and bond prices move inversely. Gold responded. So it does not take a lot to drive volatility here. This time we have a similar situation. 4.0 expected this time, which would be unchanged from the prior month. If this were to surprise on the downside, you could see a response. If it were to surprise on the upside, you could see a response. And of course, that response need not be something, it need not have a giant deviation. We can see here it doesn't take a lot. But the critical thing here is now this release comes directly in front of a much bigger announcement and is, in a sense, a secondary source. Because the reason we care about CPI is we care about what the Fed is going to do with the cost of money in response to what inflation is doing, and CPI measures inflation. But we're going to get the Fed delivering its policy announcement the very next day. So it seems unlikely that the markets look at CPI and go, yes, we're going to make big convincing changes to portfolios for this indicator that hints at what the Fed might do next, when the Fed is going to tell us directly 24 hours later. So what is likely to happen here is perhaps a bunch of knee-jerk volatility, but ultimately not really trend development, not really a convincing push one way or another for markets, because they're probably just going to want to wait and hear it from the horse's mouth. Now, on that point, there has been a tremendous dovish shift in expectations through November. The likelihood that we're going to get any policy change this time around, we can see, is a meager 1.2%. So the markets don't think this is going to mean anything as far as actual changes in interest rates. January is also seen fairly quiet. And then as we start to go from March onward, we start to see a steady build in rate cut expectations. The first cut we can see fully baked in at this point for May. So if we look at that numbers hike cuts column, we can see 1.068. That means a full 25 basis point rate cut is priced in by then, with a 6.8% chance that it's a 50 basis point change, or that a cut has already occurred in March. We can see the likelihood of that is 44%, so a bit less than even. And there's another one then in May. But any way you slice it, whether it's a cut in March or a cut in May, one of those months is likely to give us the first decline. And we can see the market is leaning in the direction of May. There's a 63.3% chance of a cut at that meeting versus a 41% chance of a cut at the March meeting. So the market is leading May for the first cut at this point. We then see the second cut baked in by July, the third by September, the fourth by December, with a 45% chance of a further cut. So we are at this point looking at 1% in rate cuts next year, and a significant possibility that it'll be 1.25. And then that quarter is fully baked in for January. This is a lot of easing. This is a lot of rate cuts, all in a very short period of time, especially in an election year where the Fed doesn't really love to make changes close to the actual voting, because, of course, it doesn't want to appear as though it is leaning on the economy one way or another around a key decision. So that, of course, constrains the Fed's opportunity to act even more, gives it fewer meetings in which to maneuver. So to see this much easing in a relatively short period of time seems very, very intense of a policy change. We can see here how this has evolved since the Fed last met on the 1st of November, where the policy implied path was set at that meeting, or at least where the markets thought it was at that meeting, is the big dashed line you see on the chart. A week ago, you can see we got a little bit more dovish than we are currently. That's the solid line being a little bit higher than the small dots line there. But we can clearly see there has been a pointed dovish adjustment. So looking especially from 6 months to 3 years out, we can see rates are now expected to be significantly lower than what the Fed had the markets thinking when it met in November. So since that meeting, clearly there has been a dovish shift. And seeing that is very easy to do, looking at the way that bond yields have responded really over the past 2 Fed policy announcements. So note here, the last time that the Fed had one of these big quarterly announcements, this is like the December one that we're looking at right now, where they're going to update not just what is going to happen with interest rates, not just give a press conference, not just give a policy statement, but also issue updated economic forecasts for growth, for inflation, for employment, and for the expected path of interest rates over the subsequent 2 years or so. So September was the last time they did that. This will be the next one. In September, the Fed pointedly said what it needed to say to markets through those forecasts, where they said, yes, we're going to cut rates likely in 2024. Rates are likely to be higher next year than this, or higher this year than next year, excuse me. But the degree to which we're going to cut them is going to be 50 basis points less in cuts than we guesstimated in June. So the Fed told the markets, we need higher rates by about 50 basis points in 2024 than we thought in the previous update. That already was enough to get the markets moving. We, of course, heard no shortage of people saying the Fed is signaling they're going to keep rates higher for longer. And, of course, the markets looked at this and said, okay, well, we get higher. But what does longer mean? How much longer? You said 50 basis points higher, but how much longer? And so the response from markets was to price in more uncertainty about the longer-term path of interest rates. So what you see here is very pointedly on September the 20th, after that Fed meeting, the 10-year yield opens up a widening gap between it and the 2-year yield. The 2-year is the more sensitive to near-term policy expectations, and the market at this point isn't baking in any more rate hikes. So you can see from September onward into November, the 2-year yield basically doesn't go anywhere. It's staying still because rate hike bets aren't moving. But at the same time, uncertainty about how much longer is implied in higher for longer builds more of a term premium or an uncertainty linked to time into the bond market at the longer end. Essentially, markets are saying, well, if we're going to lend over a longer period of time, given this uncertainty about where rates are going over that time horizon, we're going to require more compensation for that added risk. So the term premium reflects what that added compensation is. And as we can see here, it surges. And as it does, the 10-year yield jumps. Come November the 1st, the Fed comes back and says, right, so that extra tightening that we wanted to see, you all have just done it. So we probably don't need to do anymore. And again, marks the turn in markets. The 10-year yield reverses, and we can see that the term premium here, the yellow bars, that starts to fade out of the markets. Not only that, but at the same time, the green line, the 2-year yield, starts moving lower because the markets take that announcement as confirmation that indeed the Fed is angling to cut sooner rather than later. And that's where we get this dovish adjustment in policy. That's where this November shift comes from the big dotted line to the now solid one. And we can see the way that the markets were responding. Here is the S&P in the red, just to give us a sense of what the overall Wall Street mood is. And with it, the gray bars is the amount of easing that the markets expect between December of this year, so this upcoming meeting this week, and December of next year. So this meeting and all of 2024. And we can see exactly as the markets are responding since mid-year. They expected a lot more cuts at mid-year. Market was just coming off the banking crisis and the loud debt ceiling debate that was taking shape at that time. As those risks got contained, the markets thought, oh, well, okay, so there's not going to be a crisis linked to either of these things. So fewer cuts are needed. You can see the gray bars get shallower. But of course, that also means borrowing costs are going to be higher for all manner of economic activity. So financing earnings for companies is going to be more expensive. So stocks go down. So as we've had the expectation of higher rates, so too we've had lower stocks. Here is September. This is the September 20th FOMC right here. We can see that in its wake, the markets really do the full lift in reducing rate hike or rate cut odds. They sort of get to the turning point on this. Stocks have their one last push lower. From there,
you're not sharing.
From there, we get a shift. And apparently we have an issue with our screen here. Let's see if we can change that. Here we go. Hopefully that shows up better. So again, what we're seeing here is a shift. Let's point this out since we were having some screen issues here one more time. Here is the mid-year. Here are those gray bars giving us the stock of rate cuts for next year. Here is that pullback in rate cut expectations. Here is the decline in stocks as that was going on. Here is the turn. This is the shift into November, where the Fed says, oh, actually, we don't need any more. You've done this for us. We don't need that extra 50 basis points in actual policy changes. And again, here's the chart in case we missed this one as well. Here is where those changes occur. Here is the September meeting where the Fed creates that additional uncertainty. Long rates go up, short rates stay. Here is November where that reverses. And we can see the term premium fades, long rates decline, rate cuts start to come in to short rates here. The response, of course, is stocks soar and more rate cuts are being baked in. But now we're stuck. It seems like at this point, the markets have baked in what they were going to do. And we're not making new lows on this. It's a similar story when we see the response from the US dollar. As there were fewer cuts, so too the dollar's yield advantage expanded and it was rising. As we got the turning point going into the beginning of November right here, more cuts and a weaker dollar, but again, we seem to have anchored. And so we again are looking at a situation where perhaps we are done looking at this being baked in. Perhaps the markets have already done that and are looking for essentially the next shoe. Now, if we take a look at the way that the Fed might be looking at this, we can see that in the green is the 12-month Fed policy outlook. And here we can see that indeed, since November, it's been moving to a more dovish setting. More cuts are being baked in, as we've just seen. But also inflation expectations have been declining. And so what we see here then is the market is looking at more rate cuts and saying this will not be an inflation issue. Cutting rates will not take inflation expectations higher because we now are looking at a much slower economy, much weaker growth. The Fed has done what it needs to do. It is on a path to be able to afford cuts. So if you're the Fed, then ostensibly you don't need to change anything here. You might come out and give exactly the same thing, the same kind of rhetoric that you've been giving. Now, of course, there's going to have to be disclaimers. The Fed is going to have to say, look, if inflation creeps back up, we're going to have to do something about that. We're ready to act, et cetera, et cetera. But the market has already written off that kind of commentary because it's been a broken record sort of narrative for the Fed for the better part of a year, year and a half. And we can see at this point, whether it be the latest speech from Fed Chair Powell at Spellman, whether it be comments from other Fed officials or recent incoming data, the market is at this point saying, yes, we know the Fed is going to act if they need to act if something weird happens. But that isn't the path of least resistance at this point. They are biased to cuts and hikes are over, and that's going to be okay to contain inflation because clearly the markets think inflation is already heading lower despite this turn. So from the Fed's perspective, they don't have to say much of anything that's meaningfully different. For the markets, having made this aggressive adjustment through November, they're probably going to want to hear some endorsement of that shift. And if all they get is baseline status quo, there might be a sense that a bit of cold water has been poured on dovish hopes. So you may get a slightly weaker response from stocks. The dollar might continue to go higher because the markets might take that as a cue to say the Fed didn't view the past month as nearly as much of a watershed as markets did. So perhaps the enthusiasm could stand to be curbed some. But from the Fed's perspective, actually pushing back in an aggressive fashion probably doesn't make sense either, because everything they're attempting to do is at this point seemingly working. And finally, closing out the week will be a pair of two policy announcements, one from the European Central Bank and one from the Bank of England. Here too, not surprisingly, there have been aggressively dovish adjustments in policy expectations, not only because when the Fed moves rates, they move virtually everywhere because the Fed is the steward of the US dollar, which is the quintessential unit of commercial exchange. And so we ended up with a situation where as policy expectations for the Fed shifted to a more dovish setting, it was the same across most of the world economy because of the dollar's importance. Because when the Fed changes borrowing costs, it changes them virtually everywhere, because virtually everywhere the dollar is the quintessential unit of commercial transaction. But of course, these central banks also changed their tune in line with something similar to what the Fed has been saying. Only in their case, it's more acute. And we can see for the UK, it's much the same thing, a dovish shift in expectations here as well. Both of these economies have been in recession, or at least something very much like it, whether you want to assign it the official definition or not. Looking at their composite PMI numbers that capture what the manufacturing and service sectors are doing in both economies, we can see, and of course this is as ever in the logic of PMIs, so 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. You can see that since the beginning of about, let's call it the second quarter, maybe a bit toward the end of the first this year, both of these economies turned sharply lower. In the case of the euro area, we can see that line is still below 50. They're still in contraction territory, and that economy has contracted for 9 months consecutively here. If we look at what's going on with the UK economy, it's had a 3-month run of contraction that was punctured by a slight expansion in November. But both of these economies are clearly under very, very significant stress. Growth is looking very weak in both. And at the same time, inflation expectations here taken from the swaps market, the five-year swaps, giving us a 5-year inflation expectation view for both the Eurozone and the UK, they've been falling for the past 2-3 months. And most pointedly, last month, despite the dovish adjustment in policy. So again, we are looking at more rate cuts coming into the forecast, and the market saying, yeah, but inflation expectations are going down anyway because the pain in these economies is now such that they don't need to tighten anymore. Inflation is now moving lower and will continue to move lower, and cutting rates at this point would make sense because at this point inflation has a cap on it. So with that in mind, you probably have given both the ECB and the BOE the clearance to do relatively little and to basically just repeat much of what they've been saying. Again, all the usual disclaimers are likely to be there about the need to fight inflation, the primacy of conquering it, the vigilance with which these central banks will attack it if it rears its head again, but also that they're probably done raising rates and that the next steps are probably cuts. Now, if they don't push back at all, or don't appear to push back at least, on the dovish posturing in markets over the past month or so, that probably spells weakness for the euro. It probably spells weakness for the British pound. So if the Fed has the US dollar somewhat stronger coming out of its policy announcement, where maybe it might, even in its inaction, even in its reluctance to endorse what the markets have done, give the dollar a bit of a lift, that lift might get amplified if essentially a similarly status quo message is to come from the major central banks in Europe. And just to make sure that we touch off here some of the bits that maybe we missed, I'm not sure where our charts got cut off, but again, here is the expectation for CPI in case we didn't get to see it earlier. You can see the core number there, seen holding unchanged at 4%. The headline, because of energy, that's the yellow bars on the bottom there, dipping down likely to take us from 3.2 to 3.1% on the headline. Expectations for Fed policy, no changes here baked in, as we can see for this meeting, just 1.2% as we mentioned earlier. No changes for January. The first cut baked in right here for May, second by July, third by September, fourth in December with a 45% chance for a fifth. There's that dovish shift in the Fed policy path from November through to now. November is this line right here. We can see rates now expected to follow a lower path, albeit last week was even more dovish. And that is macro money for today. Apologies for the technical difficulties. Thanks very much for joining. As ever, we are here every Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what it might mean going forward. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Good luck out there this week. Take care.